Hello, everyone. Welcome to the Stock Market Jumpstart. My name is Elizabeth Booker, and today we have with me the amazing Andrew Stotts. And if you haven't heard Andrew Stotts speak about investing before, you're going to be blown away. As you know, I'm a financial coach here in the UK, and I help women change the way they think about money so that they can start building wealth. And today we are talking about investing, stock market investing, particularly. And Andrew is an award-winning financial analyst and an investing expert. He runs a podcast called My Worst Investment Ever. And I've been on his podcast before. It's such a great show. You can definitely look it up and get some ideas of what people have done wrong, and that they wish they could have done different. And you can also look for my episode as well. So I will let Andrew introduce
Yep.
himself for a minute, and while he is introducing himself, I want to ask if why while he's introducing himself, I want to ask if you can put in the chat the reason why you joined this class today. Just put in the chat the reason why you joined this class today so we can have an idea what you are thinking about. So hi, Andrew.
All right. Well, thank you for having me and thank you for inviting me. And your episode was episode 313. That was in the January of 2001. And so for the listeners out there, they can go to myworstinvestmentever.com and type your name in the search bar and they'll be able to find it. So that was a great conversation and it was great getting to know you too. And I like what you're doing. And I'm particularly interested in women. And the reason why is because I had a mother who's a woman, and I have sisters who are women, and I have 5 nieces who are women. And so I'm surrounded by women. But what's most important to me is I think it's easier for a man, and a man maybe he's more confident in investing. In fact, research shows that women, actually professional investors, women are better investors than men because they're more risk aware. Whereas men, tend to be pretty, let's say, aggressive and risk taking. So I basically want to just introduce myself by telling a story. And the story is that when I was young, my parents, let's say we grew up in kind of middle class or upper middle class in America. My dad had a job. My mom was a housewife. They had 3 kids, and my parents took care of us, reasonably well. Then my dad retired from his job. Again, one job, he was a salesman, and he retired. He and my mom retired, and they had 22-year retirement. Were in their same house, living their same lifestyle. At the end of 22 years, sadly, my father passed away when he was 82. My mom was 78, and I brought my mom to Thailand. And I sat down with her, and she had had some strokes, and I sat down with her and said, "Mom, we're going to discuss your financial position." And I looked at my mom and I said, "You have $1 million. You don't have to worry about money for the rest of your life. You can't spend the money that you've saved and invested." And that's what I really want for the women in my life and the women that I work with and teach and all that is, how are you going to make sure that when you can't make any more money, that you're not a dependent on other people? And that's why I wrote the book, How to Start Building Your Wealth Investing in the Stock Market, and I have a course on that. It's not my primary part of my business, but that is really what I want is I want people 10 or 20 years from now to say, "I'm glad that I met you then because it set myself on a path to get myself to be independent and not be a burden on my family and on my kids." And if we can achieve that, what a dream.
Thank you for sharing that, Andrew. That is such a great story. I know I've heard that story several times in different ways, but I I think it's the way you even worded it today. Being able to get for your mother to get to that place where, she had health issues and she's lost her husband, yet she was in a position where she was not going to feel like she was restrained financially in her later years. And how old is your mother now? May I ask?
She's 85. She came here when she was 78. I'm in Bangkok for your listeners and your viewers, but she came here when she was 78, and she's getting old now, and her mind's slowing down. And I've found a great doctor that basically can take care of older people at home because she and I discussed it, and we don't want to get involved in hospitals and all of this stuff. If we can do home treatments, and we got a good doctor, and she's pretty healthy now. So
Amazing, amazing. So that's great. So now, your mom's in that great position. How can we get into that great position? So, in terms of ensuring that in the next 10 years, in the next 20 years, in the next 30 years, we are still doing things that will help us make sure that we are financially independent when we are any age, depending, because we
yeah.
right now on the call we're a variety of ages. Some of us are in our 20s, some are in our 30s, some are in our 40s, some 50s, some 60s. So whatever age where we want to get to, what are the things that we need to do so that we can set ourselves up? I know everybody wants to invest, but surely there may be there are some things that we have to do before we get to that position of being able to start to invest.
So I think the most important message that I'd like to get across to everybody is the concept that I always say: create, grow, protect.
Mm-hmm.
Forget about the stock market if you're not creating wealth. So once you've created wealth, then your job is to grow it. So what I want to talk about is create, grow, and protect. So the question is, how can we create wealth? Well, there's two general ways. First is marry someone rich. Well, okay, maybe I created wealth if I could marry a rich woman, but outside of that, which I haven't been able to do, I have my own business. And that's one way to create wealth. And every single month, my business makes profit. And I own 40% of the business. And therefore, if the company makes, let's just imagine the company makes 100 in profit, we decide to pay out 50 of that as dividends. And so I'm going to get 40% of the 50 in dividend. That is a money machine. And it doesn't matter whether you got a big business or small business, an online business, or any type of business. If you can get a revenue stream and keep your costs low, then every single month you are creating wealth. Now, there's a second way to create wealth, and that is from a job. And when we have a job, let's imagine that we have a job and we're being paid 100 every month. And let's imagine that we spend 99. Well, congratulations. We've created 1,000, or sorry, one in this case, if we say 100, one of wealth. It's a cash machine. That one is coming into my bank account every single month. Of course, if I was being paid 100 and I was spending 60, instead of one, I'd have 40 coming into my bank. Then I really have my wealth machine maximized. So what I really like to focus people on is getting your wealth engine cranking. And that's the first step. And when you're creating wealth, you're probably putting it in the bank. And now we get to the next step, which is grow your wealth. That's what the stock market's for. A lot of people go in with the wrong idea and they think the stock market is for creating wealth. That's where they get messed up. So as long as you understand that the stock market is for growing wealth, you already started from a good position. And then, of course, as you grow your wealth in the stock market, you need to protect your wealth. And there's all kinds of ways that we can lose our wealth. And that's what my podcast is all about. Having interviewed now 800 people almost, I've just heard of so many ways that people lose their money. And so there's some core principles that I would highlight for investing. But for right now, I just want to focus people on create, grow, protect, and ask the question, is your wealth engine optimized? Is it cranking? Are you creating wealth every single month? That's my question to everybody. And if your answer is no, that's okay. But now's the wake up call, because there is nothing that will help you build your wealth over time than actually creating it. No stock market investing, no, other schemes or other things or crypto or whatever the idea is. Nothing will beat constant creation of wealth every single month.
Thank you for that, Andrew. So, 1 second. Yes, so we create wealth, and you gave us two examples. If you have a business and you're bringing in revenue, and you said, get that revenue stream flowing and keep your costs low. And then if you also, and maybe you don't have a business, you have a job, you can keep getting that income, but you keep your spending low so that you're living below your means in your income, or you're spending below your means in your business, and you're able to have something, you're able to keep something that you can now push to the next stage with is grow in the stock market. And that's what we're going to focus on today. But first, put in the comment a one if you are already creating wealth, no matter how small or big. If you have a business or you have a job, put a one. If you don't have either, put two in the comment. And then maybe we need to talk about what we can do to get you to that stage, because we're going to move to step 2 now, which is grow. But if you aren't at step 1, which is creating something, then put a 2, and then we can see how we can help you walk through that to get to the first step. Okay, so I'm seeing some ones, so I want to see some more numbers in the chat. Okay, so now we want to grow, and we've seen in the chat, some people have said, what things do they want to do? What do they want to learn here? And I asked the question, if for those who weren't here at the beginning, what made you join? What made you sign up to this class? And some comments were they were here to understand the basics and the ABC of investing. So can we start off looking at the ABCs as their developer put it, of investing? What would you say they are?
So I think the best advice that I can give in relation to investing is there's only one, what we call asset class, that is the one that's going to earn you the real money over a long period of time. And that is what we call equity or stocks. So there's a few different asset classes. We have stocks, we have bonds, we have commodities, and we have gold. Gold is actually a commodity also. So really it's stocks, bonds, commodities. Now we also have real estate, but in the stock market, real estate it behaves like a stock, and therefore it's part of equity. But having a piece of land or having an apartment or having a condo or a home is an asset class. But people ask me what's the best asset class to hold, for instance, in times of inflation. And what I tell them is that there is just simply nothing that can beat investing in equity. And equity basically means investing in business. So to give an example, to tell the story of my own situation, my best friend, Dale, runs our coffee factory that we both own 40% of. And I'm not an employee of the business, I'm an outside investor. And we set it up together, and I have my own business also. So basically for Dale, when coffee prices went up, in fact, right now he's dealing with a 175% rise in one type of coffee. And basically what he's doing is trying to figure out, can I increase prices? Can I cut costs in my factory? Can I figure out a way to change my blends to compensate for this very high cost so that I can maintain the profitability of our business? Now, that's not easy, and he's working hard to maintain that, and he's done a good job of that. And he's got a management team. And the management team, I meet every 2 weeks at the factory, and I sit down for 3 hours with them to go through things, and they're working so hard to deal with that. But I'm not. I'm an investor. And I go home and I do my job, which is my own business, and then I go back to talk to them. Now, it's amazing. I have this CEO and team working for me, and I'm not in the company.
Oh,
That's incredible. And that is what stock market investing should be seen as, is that you're investing in a company that is run by a CEO and has a management team. Now, if you invest in 10 companies, now you have 10 CEOs working for you and 10 management teams, and 100 or 1,000 or 10,000. The most that you could invest in the stock market easily is 10,000 companies. That means you have 10,000 CEOs, 10,000 management teams working. Doesn't mean they're all going to succeed. Some are going to fail, some are going to go well. But there's nothing, gold will never have the power of human ingenuity behind it. Property will never have that power. And that is the reason why investing in stocks or equities, or what we would call investing in companies, there is nothing that beats it over the long term. And so I just want you to focus in that that is the main asset class that you want to be focused on.
that's amazing. Thank you, Andrew. And for those of us that don't know, can you explain what is a stock?
So if all of us in this group were going to set up a company, and let's say we're going to set up a coffee shop, and but we need £500,000 to buy the machines and buy the coffee, hire the staff and all that. And then we decided that we would all go in equally on it. Let's say we're 100 people, we each put in 1%. We each own 1% in that company. Maybe we're 10 people and we each own 10%. Or maybe we're 2 people and we each own 50%. This is what we would call a shareholder or a stockholder in a particular company. Once we put our money in, now the company has been established, it has cash, and the job of the company is to invest that cash to earn more than that cash. Because if you can only earn the yield on cash, I might as well keep my cash in the bank. But if you come to me and you go, I got a coffee shop idea in London, and I think it's going to make a 10% return every year for the next 10 years, then I would look at that. And that is stock market investing, or sorry, company investing by buying a stock. And that is the idea of owning a share or a stock. When I say stock, I mean share interchangeably. Now, let's say that you're really successful. Over 10 years, you get 100 shops, your business gets big. Let's say I own 10%, and you tell me, Andrew, I'm going to list that stock or that company in the stock market. Now, in the past, we had a problem that I may have said to you, oh, I want to sell my shares because of blah, blah, blah. And you say, well, there's no buyers and I can't find a buyer. I'm sitting here in Bangkok. There's just not a market in the shares of the company. So I just hold on to the shares. But once you list it in the stock market, then if I decide I want to sell 5% of my 10% holding, I can just do that easily in the stock market. So when you're investing generally, as you should be investing in the stock market. Occasionally you may invest in individual business, but I like to tell people that, don't go rushing into if you're not a business person and you're not an entrepreneur and you've got a good job, stick with it, because you can create wealth. And my mom had $1 million at the end of her life, and my dad was a salary man, and he did it. He didn't get any inheritance. They did it through, saving and investing. Okay. So I said a lot there, but you have to keep asking me questions so I don't go off track.
Yeah. So a stock is a piece of a company. And so if like 100 of us decide to buy a piece of a particular company, that is what is explained as a stock, or also a share of that company. You mentioned some other asset classes. Can you explain to us what is a bond and how that is different from a stock?
So let's say that you've listed your company in the stock market, and now you have a good reputation. People know your company and they know your, let's say, coffee shop, and now there's 1,000 shops, and you've got a very stable business with a stable cash flow. And you go to the bank, a bank, and you say, I want to issue a bond. And what that basically means is that I want to go out to the market to individuals or institutional investors and say, I'm going to sell you this piece of paper, and you're going to give me money for that piece of paper. And that piece of paper is a document that says, I owe you the amount that you lent me. Let's say it's £1,000 as an example. So basically, you have a document now that says, I owe you £1,000 and I have your cash. And now what I do is I do my business as normal. And in that document, we agreed upon an interest rate, let's say 7%. And now every year I send you a check or deposit into your account 7% of your initial investment. You're happy because 7% is a lot more than you're making in the bank, but you're kind of bummed on the other hand because let's say that my company's booming and we're making a lot of profit. You're going to get none of it because you're only going to get that fixed coupon of 7%. Now that's okay. Maybe that's where you're at right now. You don't want the risk. You say, yeah, it's going good now, Andrew, but it could crash. So a bond is a much more secure investment in a company. So you could be a shareholder in a company and own equity, or you could be a bondholder and own a bond that you're receiving some interest payment on.
That's amazing. Okay, so someone put for me, what you understand is the difference between a stock and a bond, so that you know when you're about to buy, you're about to invest. If you're going to invest in bonds, you know it's going to be a little bit more secure, but it's a fixed interest rate. But you're invested in a stock, it's maybe less secure, but you will be growing as the company is growing. Um, you also mentioned, Andrew, that the maximum that someone could invest in is 1,000 companies. You said we could invest in one particular business, or you could invest in 100, or we could invest in 1,000, in 10,000.
Yeah, 10,000.
How would we invest in 10,000? Like am, I am a person here in the UK. I have a job. I have a family. I have children, and I haven't even started investing. How would you advise me to start investing and even up to 10,000?
Yeah, so basically, there is an instrument called the VT Fund by Vanguard, and the VT Fund. I'm not up on the latest in the UK, and so I can't tell you exactly, but we can dig around and look for it. But the VT Fund is a passive fund run by the company called Vanguard that has operations in the UK and the US, but it's a US company, and it owns 10,000 companies. So if you were to buy one share in the VT fund for, let's say, £50 or $50, you're going to be buying a fraction. You're going to own a fraction of each of those 10,000 shares, 10,000 different companies. And there is no more diversified instrument that you can have. That is the most diversified instrument.
Yeah, that's amazing. So you said it's a passive fund. What can you clarify what you mean by a passive fund?
Yeah, so most mutual funds in the past, let's talk about a fund in general first. So a mutual fund or a fund, an investment fund, sometimes it's called investment trust, but these funds are basically, in the past, a smart man or woman who was good at investing in the stock market would set up a fund, and then they would advise the fund what to invest. So that smart man or woman would have an advisory business and they would have a fund. They're two separate things. The advisory business tells the fund what to buy and sell. Now, the reason why it's important that these are two separate things is because you don't want a situation where, let's say, 1,000 people put their money in that fund and then the advisor goes bankrupt. Wait a minute. If the advisor goes bankrupt and they're two separate things, the advisor's business disappears, but the fund never disappears. That's all our money put into a vehicle that is heavily regulated by the SFC, I think, or SFA, FSA. I can't remember what it is in the UK, but it's heavily regulated structure and a very sound structure. So basically, what happens is that the fund manager then manages the money that we put into that fund. The benefit for us is, well, we get an experienced fund manager working on it, number one. And number two is that fund manager is going to own like 50 or 100 stocks or companies. And that's going to give us diversification that we're probably not going to be able to get as an individual. Like, how would I know what stocks to buy or sell to get 100 stocks? And so we get those benefits from it. Now, that is a fund. There's two types of funds. One is active and one is passive. 30 years ago, 40 years ago, there was only one type of fund, and that was active. There was a smart man or woman at the top running it, and we put our money with them because they were smart and they did a good job. But the problem is that the stock market is so complex that nobody can beat the stock market through skill over a long period of time. They can beat the stock market through luck, but it's very hard. About 95% of all active fund managers over the longest time period, let's say 20 or 30 years, about 95% of them cannot beat the market. And that's because first they have fees, and those fees can sometimes be hard. But also, it's just too complex. The market, you may think that you've got a really smart idea, but because there's millions of people playing in the market every day, it's very hard to beat the market. And therefore, we also have passive funds. And passive funds just buy every stock in the market. So the smart fund manager that runs the passive fund goes into the office in the morning, turns on the computer, calculates the proportion of all the stocks in the index. Let's say there's 10,000 stocks in the index. And they say, okay, some stocks have moved up and some stocks have moved down. So I've got to buy and sell a little bit because I want to match the index. And then they do that for about an hour. It's an Excel spreadsheet. And then they send in their order to the broker. They make some slight adjustments and then they go home. Because now they've set the passive fund to match the market. And that is what a passive fund is compared to an active fund. And the benefit for that passive fund is that it is a lower fee because the person's walking in, turning on the computer, doing some calculations, sending in the orders, and they're not trying to research companies. So that's my best explanation I think I can give.
Yeah. So that's great. So there are two types of funds, in passive funds and active funds, right? Active funds, you have someone who's a fund manager who's being paid to actually ensure that and research and make sure that the companies that are in the fund are beating the market, which they usually can't. And you've got a passive fund, which is computer programmed, and the person is not trying to beat the market. The person is just like copying what an index, the company's in an index, and just trying to match the market. And a fund, you explained, is literally like a pot, right? A pot of multiple companies. The pot of multiple companies from, different industries. As you mentioned, maybe it's fashion or construction or different industries and different countries, and it's very diversified, right? It's very mixed up, and that reduces risk because would you say that reduces risk because
Well, because when one's going down, when one company's going down, one company's going up.
exactly.
And that means that, overall more companies are going up than going down. And so you're getting that. But if you were to build your own portfolio individually, and let's say I like Apple stock, and you buy 100% of your money you put in Apple. Well, what happens if Apple the US government sues Apple and restricts them and the share price goes down by 50%. But if Apple was one of 100 or 500 stocks in a portfolio and it went down 50%, yeah, Nvidia's going up by 50% on the other side of that.
Yeah, exactly. So it reduces risk. So where one part is dropping, the other part is going up. It's very interesting in the pandemic. People who were invested in a lot of say might have felt, or in terms of real estate, I mean like housing, housing, office buildings. They might have seen their portfolio dropping, but if you are also invested in, on technology, you might have seen your portfolio rising. So not knowing if you don't know where you want to put your money in, and it's best not to even speculate. It's best to just invest in a fund that is diversified across multiple areas.
Yeah, and then once you find the right fund, whether that's the VT fund or a fund like the VT fund at any investment house, they have a large global passive fund that's low cost. Once you find the one that you like and you start investing in it, I tell my nieces, and I told them when they were 18, never sell.
Never sell. So tell us why you say never sell. You find a
So
fund,
let's
stop putting money in, and you never sell.
so let's think about it from a perspective of we were an active fund manager. We would identify 10 or 20 stocks, and let's say people on this call say, Andrew, I have a brokerage account and I like to buy and sell stocks. So what do I do? Okay, let's say you buy and sell and you have a portfolio of 10 stocks. They're good stocks, you like those companies, fantastic. But nothing lasts forever. Every company will face pressure, and some companies will go bankrupt, and some will face trouble that it takes years to recover from. And therefore, we know that there are cases where one of those stocks out of 10 or 20 that you're holding could go down to 50% down. It could even go down 100%, and you lost all your money. So I'm not saying if you own individual stocks, never sell. Because if you own individual stocks, you really have to watch carefully. I use stop losses for individual stock portfolios. Every 3 months, I look at the price. Let's say the price is 100, and I say, if that goes down to 120, I'm selling. And that's the concept of a stop loss that forces you to get out of something that's losing. It's not for everybody, but it works for me, and it's one very good way if you're buying individual stocks. But if you're owning a fund that owns every stock in the world, or let's say these 10,000 stocks, you can't get more diversified than 10,000. Now you can get diversified by asset class and say, well, Andrew, I bought this piece of land that I want to build something on in the future, or I may sell it to someone who wants to build something on. And I put 500,000 or 300,000 in that land, and I put 300,000 or 500,000 in stocks. You are now diversified across asset classes. But within the asset class of equity, within that asset class, once you have the maximum diversification, now you are exposed to the global equity return. Whatever the stock market goes up or down over the next 20 years, you're going to get that. And on average in the past, that's been somewhere between 8 and 10%. And so there's no reason to sell. And you could say, oh, but Andrew, I think that the market is going to fall, so I want to sell. Yeah, but now, first of all, you have to be right. You could be wrong. And the second thing is that, okay, let's say you're right. Now you also have to be right about when you put your money back in. And therefore, it's much better just to let your money grow over time. So that gives you a picture of why I say never sell, because people get it in their head. And I just was talking to someone yesterday, and they're like, I'm really worried about the market right now. And And I said the reason why I'm a good advisor to people and the reason why I'm a good allocator is because I'm never worried about the market. Market's going to go up and down. It's the best we have. I mean, we could have nuclear war in 5 years and we're all gone. And then the market's going to perform bad. But overall, if life continues to go on, we're going to have a market that does okay. And I'm going to have exposure to that. And then I'm going to continue to contribute to that on a regular basis. And when it's down, I'm going to buy more. When it's up, I'm going to buy less. Done.
Amazing. Um, we have a question that says, as a young investor, would you advise to manage stocks through a broker or manage myself? One challenge I currently face is monitoring stocks and knowing when to sell and buy more. So one thing I am interested in with this question is, are you talking about individual stocks or you are talking about a fund, the group of stocks?
And I think that in this case, Debola is talking about owning individual stocks. Yep. Okay. Um, Generally, I would advise against owning individual stocks unless you have knowledge about investing. And, let's say you've read 5 or 10 books on investing. You've maybe read some of the main academic papers that talk about some very, very well-known concepts that help you to improve your investing. And also if you have time. So if you have knowledge and you have time, but also you need interest. So you need interest, you need knowledge, and you need time. Why do I say time? Well, because one part of my business is managing people's money, and I do that in Thailand, and I help Thai people to invest globally. And my portfolio is roughly, let's say, about 80 million US dollars. And it's a 24/7 job to think about investing, to think about what's happening, to think about the portfolio, to manage risk. And so therefore, I generally would tell people who maybe have some interest but don't have much knowledge, or have a little bit of interest, a little bit of knowledge, but they don't have that much time, just buy a fund. What's the objective? You know, in this case, I'm assuming for Debola that the objective is to accumulate the most amount of wealth that you can over the investment period that you have. And in order to do that, I would say buy a good low cost diversified equity fund and get back to your wealth engine and crank up your wealth engine and use the stock market through one highly diversified fund. And I think, Elizabeth, you and I, after this, can go through and do a little research over the next couple of days, and we can look at a couple of different options that are available there. But then get your priority right, crank up your wealth engine, contribute regularly to one fund that you know and you understand that's highly diversified and is probably a passive fund, and then grow your wealth.
Amazing. Thank you so much for that clarification. So we have a fund, we are putting money in each month, and we are also working on our wealth engine. Is
Yes. What it is she'll have to now.
yeah, sorry. So we
That's
are investing. I'm definitely interested in diversified funds. Okay, yeah, sure. So we're investing in a fund that is diversified by country, by industry, and we are also at the same time working on our wealth engine. So if that's through your job, if that's through saving from your income, or through your business, keeping your business costs low and keeping your and making money from your business, and then being able to now allocate that saving towards your investment, and you keep going for the long term. And once you're investing in funds, we don't sell. Now, if there is a recession, with the UK, we are in one, so it's not if. But when there is a recession, what do we do? Because there's so much fear around in the news and the papers. Everyone's, feeling fearful. What do you do with your fund that you're investing in during a recession?
So the simple answer is you buy more.
Can you tell us why?
Because usually in a recession or around a recession, the stock market falls. Not always, but usually in a recession, the stock market falls. And that's the time that, for most of the really successful investors over the years, it's not so much what they buy, it's when they buy.
Mm.
The richest, I was just I I read every investment book that exists, and I write courses nowadays on each one of those, and I then record those courses. And I was just recording a course that talked about a guy named Howard Marks, and Howard Marks is a famous investor in the U.S. And he's very good about timing, and he's also good about distressed debt. Distressed debt is like the bond of companies that are facing trouble. And he knows that those prices can go down really low. And then he buys them up, and then he basically gets a big return. Well, in 2007, stock market, oil, everything was at its peak, particularly in the US. And in 2008, the markets crashed by 50%. What he did at the end of 2007, he went out and he raised 13 billion or $11 billion. And he got people to put $11 billion into his fund for distressed debt. And in 2008, when everything crashed, he just was picking up everything he could that was cheap, and he timed it perfectly. Now, none of us are going to be perfect like that. But the point is, a recession or a market collapse is an opportunity. We must always see that. Now, if you look at a stock market chart and you look back over, just in my case, let's say 30 years that I've been in the market, and you look at the stock market fell by 50% in 2008, and you say, ask yourself, why didn't I buy then? I could be super rich if I had bought at the bottom. But the reason why we don't buy at the bottom is because of fear. We're afraid it's going to go down more, number one. We could be afraid we're going to lose our job. We could be getting other pressures at the time. And so when fear takes over, people do just the opposite thing. They usually sell at the bottom. And so I want to tell you a funny story, Elizabeth. When I was in university, I was studying at Cal State Long Beach, and I was from Ohio, and Ohio is like no sun. So when I was in LA, and particularly in Long Beach, it was like beautiful, and there was all these beautiful women, and I was in heaven. So I was in my university class, and I was sitting next to this really beautiful woman, and we got to know each other. And one day we were walking after class, and we were like joking around, and she said, "I'd never date you." And I said, it's kind of a harsh, thing to say to a young man who's probably very insecure. And I said, "Why is that?" And she said, "You're boring." And I looked at her and I said, "Honey, someday you're going to want boring." And in the stock market, as well as in our lives, we want boring in the sense that we want something that's steady, consistent, delivering. And so one of the things that I work on in my mentality and my emotions is the ups and downs of the market does not bother me. I do not ride the roller coaster. And so I try to help people to not ride the roller coaster. But in order to take advantage of the down cycle, you have to have cash. And you have to have guts. And you have to be willing to do it. And most people don't necessarily have cash in the down cycle, and they don't have guts and they don't take the action. So that's okay. Then that's why I say never sell. Because the time you're going to be tempted to sell is when it's down. And just contribute on a regular basis. And that way you are buying when it's down. And you can say, I bought at the bottom of the market because I buy every month, as an example.
Absolutely. And something that I do is I buy a fixed amount every month. I have a direct debit with my investment account. And we'll talk about investment accounts like next. I buy,
Mm.
I spend a certain amount on my investment account. So I have a direct debit and it goes in automatically. So I'm not thinking about it. I'm not thinking, oh, actually, this month I really need to do something else. So I'm not going to invest. So I do that automatically every month. And whether during the recession, during the pandemic, during the during inflation, during good times, bad times, it's the exact same amount.
You're
Okay.
doing the exact right thing. The
Uh,
only thing, there is one thing you could do that's better.
Tell me, please. I always want to get better.
So let's imagine that you invested over 10 years in this method. And let's imagine that the amount that you invested was $100,000, as an example, over those 10 years. $10,000 per year that you invested. It would have been better if you could have invested that 100,000 at the beginning of the period, because it can compound over time. However, most people don't have $100,000. They have to contribute every month. So though it is theoretically a better option, it's not a practical option for most people. So therefore, you are doing the exact right thing for you and for most of us. And there is no other option except, let's say that, you get some windfall. Somehow you get $100,000 that drops into your account. Now you have to make a decision. Do I invest this right now or do I wait? What do I do with the market? This is what I call a lump sum problem. And in that case, I would recommend just to put 10,000 of that in every month over 10 months, because you'll really feel bad if you put it in all in and it went down by 40% in the next month and you're like,
Yeah. So you spread out the amount. So if you get a lump sum, let's say, you got
yeah,
a windfall of cash through an
even
inheritance,
spread that out.
won the lottery, you
Yep,
spread it out over 10 months or a year and put it in and so that it kind of averages out.
yep. So if anybody comes to the lump sum problem, that's one solution to it. But the main thing that you're doing, which is dollar cost averaging, fixing a certain amount every month, there isn't a better alternative than that, in my opinion.
Amazing. Thank you so much, Andrew. So in the UK, we have like 5 or 6 main types of investment accounts. There is the general investment account, which, as the name goes, is general. Like anyone, any adult can own an investment account, and you pay capital gains tax on your profits. You can have an individual savings account, which is called an ISA. And if you invest it in the stock market, it's called the stocks and shares ISA. You can have a self-investment personal pension called the SIP, which you invest, it's like a private pension. So you're
Mm.
investing towards your own pension and you can't access it till like age 59. But it works exactly the same way, except for you do have, tax advantages because you don't pay tax now, it's deferred. And then you have the junior ISA, which is for children. So if you have a child and you want to start investing for your child, you put some money in the junior ISA up until a certain amount. You can also,
Mm.
invest for corporate. If you have a business and you want to invest your business profits, you can do that as well. And you can have an investment trust as well. But for
Mm.
most people, most adults, we may want to look at investing in an ISA, a stocks and shares ISA, because here in the UK, it's tax free up until £20,000. So every year, if you put £20,000 in your ISA, you can invest it or save it. If you want it left saved, it will be a cash ISA. If it's invested in the stock market, it's going to be a stocks and shares ISA. And it's invested up until 20, you get tax-free up until £20,000 per year. And then by April, you start all over again. So right now, if you have some money, you can put it in for this year, and the year ends April 4th or 5th, the tax year ends. Each April, it starts again. And for kids, you can invest as well in the junior ISA, and it's exactly the same. It works exactly the same way. So once we have our investment accounts, whichever one we choose, whether you want to just go the general route and just, it's just a normal investment account, no tax advantages, or you want to go investing for your private pension, or you want to actually, have some, save some money on taxes and invest through an individual savings account, a stocks and shares ISA. When we decide which one we want, and I would suggest a stocks and shares ISA because it has advantages and there's no need to lose out on those advantages. Then we have to pick the investment platform that we want. So first we know what investment account we're going to open, and then we now have to pick what investment platform we are going to actually invest with. Can you give us some tips? I know you have a favorite because you already mentioned your favorite. Can you give us some tips that we can use to decide what investment platform, and when I mean platform, it's just basically a website that you're going to go into to use to create the account that you want to invest in. What tips do you have in picking the platform that we should invest in? Or we should invest with, sorry.
Yeah.
Well,
one of the things that I try to avoid, at least outside of, in Asia, is using banks, because banks tend to have very high fees on things. And that's where there are platforms like in Asia and in the US, we use Interactive Brokers. And that is a platform that has extremely low fees, and it has every instrument you could want. So there's a bank, Saxo Bank, which is a bank here. I think it's out of Europe, and but that's another one. I would look for. I'm not sure if it matters too much. What I would look for is to say, let's just say you have a platform that comes to mind. You'd ask them, how easily can you find a fund that has the closest amount to 10,000 stocks and is passive and has a very low fee. And that's all I would do. On any platform, I would ask them, what is the fund that you have that's passive and owns the most number of stocks globally?
Yeah, that's great. So you want a platform that is low cost, and many platforms are loads of, and Interactive Brokers, yes, it's a really good one. Vanguard is also good. You want one, and those are both quite low costs. You want one that is low cost because you don't want your profit to be eaten away by fees. You want one that has passive funds, and you want one that is able to have funds, or has a fund that has has close to 10,000 stocks in it.
Yeah, and if that fund had 2,500, that's actually not too far from 10,000, because of the 10,000, many of them are very small companies. So if it's 2,000, 4,000, 5,000, that's okay. It's going to have pretty much the same performance as 10,000.
Yeah.
But Vanguard is great. They're low cost, and Vanguard is one of the only financial firms that is built on almost a not-for-profit model, in that any excess profit that they get, they reduce the fees that they're charging to their clients. And so it's a very unique model at Vanguard. So that's what makes Vanguard good. Now, Elizabeth, I think that now that I'm thinking about it, we should talk about what is an ETF versus what is a fund.
You're just reading my mind.
Yeah. Because somebody's gonna go and say, okay, I found the place and I found, and but they only have ETFs.
Yeah.
What is an ETF? Okay.
Yes, you have a great
And
way of explaining this. So
yeah,
please
so
explain to us. What
I
what
mean,
yeah.
the first thing is to think that an ETF is pretty much a fund. It has everything in it that's the same. So if we go to Vanguard, you can see the VT fund and the VT ETF. They're the same. The content of the two are the same. The difference is when you buy a fund, you give money to Vanguard and they say, okay, congratulations, you bought a certain number of units. And now you can watch those, the price of those units go up and down. But when you buy an ETF, you buy it from another person. And an ETF is traded in the stock market.
Yeah.
So there's a certain number of ETFs that are traded in the stock market. If you want to buy that VT ETF, then you just buy it in the stock market. Now, the benefit is these two are very close to equal nowadays. So I wouldn't even worry too much about the differences, as long as the fees are low. Now, Vanguard, when we talk low, we're talking about 0.1% for Vanguard. You could go 0.2 or 0.3, it's possible for some, but let's say somewhere between 0.1 and 0.2 is what you're probably trying to get to. And whether that was a fund or it was an ETF, it's not gonna matter too much. Now, there may be some tax implications that I don't know, that I can't really say for each person's situation. But I can say that nowadays they're pretty close to the same. ETF stands for Exchange Traded Fund. So it is actually a fund. It's just traded in the stock exchange. Yep. Good question.
It's just a different vehicle. So thank you so much for that. So yeah, so we can so a fund or an ETF is something that we can use, and they are very similar. When you're picking an investment platform, as Andrew said, look for low fees. And if you want to have an idea of what the low fee looks like, it's like 0.1%. Because you will see if you especially if you use apps, investment apps, some you will see some fees that are like 1%, 2%, 3%. You see some fees like that. Those I wouldn't class as low fees, but you might. But in terms of low fees, I would look at like 0 point something, 0.1.
Yeah, I mean, let's say from the ones that are more expensive are generally active. And there are some times that it may make sense, but I would say you probably don't want to invest in something that's more than 1%. If let's just say you didn't have a choice and you had to buy, but it was 1%, it's not great, but it's okay. But if you can get a passive, you're going to be down at 0.1 or 0.2, something like that. And that's going to make a lot of difference over a long period of time.
Thank you so much.
Yeah.
So Adebisi has a question. Please explain what it means if a commodity has just 10,000 stocks, for example. Why is this bad versus one that has, if a commodity has just 1,000, why is this bad versus one that has up to 10,000? Just to make sure I completely understand. So,
Yep. So let me try to answer this. The first thing is that you're saying a commodity has. I think what you're saying is a fund has, because a commodity would be wheat, corn, oil. Those are commodities, and there is a commodity fund that owns many different commodities. But I think what you're talking about is a fund. Yep. Okay. So what it means if a fund has just 1,000 versus 10,000. Okay. Actually, the truth is that for a fund to be diversified. Or let's just say for you individually, if you were investing individually, the truth is that you could own about 20 stocks and be pretty diversified. For a typical fund, they're probably owning 100, an active fund, they may be owning 100. There's a $130 billion fund in America that's actively managed by Fidelity. I was just writing about it. And that fund has 300 stocks in it, which is really small number of stocks for a fund, right? It's very concentrated. But at 300, it's diversified enough that if one goes down, another one's going up. So once you go from 100 or so, you're probably mainly diversified. Going up to 10,000 is ultra diversified, but the benefit between, let's say, 100 or 1,000 and 10,000 is very small. I just like 10,000 because it's giving me exposure to every market in the world, every sector in the world, every country in the world. And that gives me comfort that if US falls, I'm going to own something else that's going to go up. That's it. Yep. So it's diversification happens very quickly. Once you get to 100 stocks, you're pretty much almost 95% diversified. But to get to 1,000, you are maximum diversified. You cannot get more diversified in equity. And for my nieces in particular, that I wrote the book for and the course for them, it's like, I want you to be maximum diversified.
Yeah, and that's very true. And based on following on from what we see her question, what she asked. There are some funds that just have 100. There are some funds that have just 300 companies. There are some funds that have more.
Yep.
And in the market, it's called there are like S&P 500, which has the top 500 companies in America. We have the FTSE 100, the FTSE 250, the top 100 to 50 companies in the UK. FTSE stands for Financial Times Stock Exchange. S&P stands for Standard & Poor. And these are indexes that kind of track, what is happening in the stock market. Can you talk a little bit about indexes and index funds?
Yeah, so
and maybe that could also help us understand like what types of funds there are and the sizes.
So let's say that you give your money to somebody and they say that they're going to manage that money for you. And they say they're going to own, let's say, 20 stocks. Okay, you like them, they're smart, they're pretty good. So you give them money and they're going to manage 20 stocks. The question is, after they've managed them, they're going to send you a chart and say, hey, my portfolio, your portfolio went up this much. And they're going to show a chart going up. The question is, how do you know if that performance is good? Well, the fact that it's going up is good. Going down would be bad. But maybe you could have put your money in another fund or another strategy or the overall market, and it could have gone up a lot more. You don't know. And that's what an index is for. The benefit of an index is to say, okay, you're investing globally. All right, I'm going to find a global index. And now I'm going to compare your performance against that global index. And it's going to tell me how you're doing relative, because I could just put my money in an index fund. And that's the concept of an index. It is a neutral, they're run by different organizations like MSCI and S&P and the like. And they're just basically constructing these neutral indices that then can be used for investors to judge whether the performance they have or their fund manager has is above or below the market average.
Amazing. Thank you so much. So if you have any more questions, please put them in the chat. Our 1 hour has so flown by really fast. And I haven't even gone through all the questions I had here. But if you have any specific questions, put them in the chat before we do round up. Okay, so we said you have an investment. First, you choose what investment platform you want. We know the things that we're looking for in an investment platform.
Hmm.
Then we're thinking, okay, what investment type of investment account do we want to open? And I shared 5 main types of accounts. If you're starting out, you might want to open an ISA here in the UK. And then you now pick what you're going to put in your account. That's the investment fund, right? And if you were using the Vanguard platform, there is a VT fund, global fund, and that's literally what it's called, the VT Global Fund. And it has so many stocks. It's heavily diversified because it's from different places. So those 3 steps. And then after you've picked that fund, you have to finance it. You have to put the money that you have made from creating money in step 1, you put the money in. And you can either put it, each month, like I do, which is dollar cost or pound cost averaging, or you can put it as a lump sum, but then there are some challenges with that, as Andrew has pointed out. Okay.
I do want to, I want to explain one other thing, just because when you mentioned about, you go to you're going to go to a platform or to a company and you're going to look at different funds. The first thing that's going to happen to the people on this call who are going to take action based upon this is they're going to get overwhelmed, because they're going to see hundreds and thousands of funds and ETFs. And they're going to think, oh my God, I don't have the skill, the time, the knowledge. I don't know which one to pick. And that is why I focus on the VT fund, or the fund that has the most number of stocks, because it stops all of the, oh, maybe I should buy a tech fund, or maybe I should buy a banking sector fund, or maybe I should buy a fund that has exposure to Germany. All of those questions are eliminated when you own a index fund that owns every stock in the world. Decisions already made for you, and therefore all you have to do is go to the platform, look for the fund that has the most number of stocks in it, and it has the lowest fee that you can get with the most number of stocks, and then do a little research, figure that one out, look at it. I think, Elizabeth, you and I can look at some after this, like in the next couple of days, and we can go through what are some options. And then you just start buying it. And that's how you overcome the overwhelm of seeing so many stocks. Even I can't figure it out. Yes, go for index funds. That's the simplest way.
Okay. And we got 2 more questions. Is there an app that you would suggest to invest for children so that at 18 they can take over their account? This is such a good question.
Yeah, I think that I'm gonna have to leave that one to you,
Okay.
because I haven't had children yet.
Okay, no worries. Yes, so there are multiple investment apps like that in the UK here, and globally as well, that you can use to invest for your children. I do invest for my children with Vanguard, and I literally, funny enough, went through their account just before this call started to see what their position was. So yes, and they can take over that once they're 18. So I use Vanguard for my children, but multiple. And the thing about it is, in the UK, we have the junior ISA, right? So if you're based in the UK, I'm not sure, but if you are, we have the junior ISA investment account that allows you to invest for children, right? So if you have that account open on any platform, it will have their name, it will have their details, and the money that you put in it will go towards them. It will go to them when they're 18, because they'll be able to access.
Um,
Um,
I One of the things I love about living in an emerging market like Thailand is that nobody trusts the government, right?
yeah.
And um, and I laugh because I think about the US government and the UK government, and of course, I mean, government is not the solution to problems, they're just oftentimes a big problem. But isn't it funny? Government takes your tax money, a lot of taxes from you, and then they say, "Oh, we're going to give you some tax advantaged funds and all of that." Why not just lower taxes? But
Oh,
they make it complicated for reasons. But all right, you have a question. One that says if one has been buying stocks directly from the stock market, what quick checks could we do to ensure we're making the best decisions on the stocks to buy? So the first thing I would do is I would make sure you have 10 to 20 stocks in your portfolio. If you look at your portfolio and you have one or two, it's not enough. You're not diversified enough. You're exposed to the risk that one of those could go bankrupt, as an example. So make sure you have 10 to 20 stocks. For an individual, it may be hard to do 20, so let's just say 10. And I would say equally weight those 10. So you put in 10% in each, let's say, of those 10. And if one goes up to become 15% of the portfolio, then take 5% of that stock's value, sell that portion, and use it to increase your, exposure to the other stocks. As far as, individual stocks and kind of understanding where you're at, I think that this is where it gets so hard. There really is no right answer. You could look at the PE ratios and try to understand maybe some of them are too expensive, but one of the lessons we learned is some very expensive stocks still go up. And so that's what makes outperforming the market so hard as an individual. So the first thing I would do is just make sure that you're well diversified. There's nothing wrong with then going through each stock and saying, why do I own this? What do I think is going to happen? A good rule of thumb is to ask the question, do I think that this stock can double its earnings in 5 years? And if you really think that this company can do that, then chances are that stock will do well.
and may I ask a personal question?
Yeah.
If in your experience, and based on the things that you're reading and you're seeing, which industries do you think will double in the next 5 years?
Well, I don't want to answer that question because it's it takes us down a rabbit hole that I think that isn't helpful for the average investor. I would rather say own every industry. And then when that one that we may say right now, let's say industrial, the industry is industrials, industrial companies are going to come back. Let's say that's the answer that I'm going to give. Well, you're going to own industrials because you're owning every stock in the market. In fact, I told my nieces, I said, when you go out to a party and you hear some smart ass guy say, I bought this stock at 100 and it went up to 200, you say, oh, I own that too.
Yeah.
And then you go to a party and someone says, I own this really obscure stock in Taiwan that makes this like really unique thing and it's really exploding. And you say, I own that too. Because you own an index fund that owns every stock in the world.
Yeah. And that was going to lead me to my second question about how to deal with hot tips.
Never ever trade on a hot tip.
Mhm.
Make that your rule.
Okay. It's a rule. Never trade on a hot tip if you've ever
Ever.
gotten one. And I think in my episode with you, I did talk about hot tips. So,
Yes. Never
yeah,
trade on hot tips.
never trade.
They're not as hot as you think.
Hmm. Yes. So thank you so much. Thank you so much, Andrew. For those who I know, and when I said
You got
I
lucky.
and it worked well, never
Yeah.
again. So
Um,
yeah,
but by the way, I'm gonna, if it's okay with you, I'm gonna put in the link to the
yes,
course.
yes,
And
please
I've
link.
got a 35% discount for that you guys can access. And it's 100% money back guarantee. So if you take the whole course and you think it wasn't what I wanted, you just ask and I'll send you your money back. So the book is called How to Start Building Your Wealth Investing in the Stock Market. And it's the same exact material as the course, but the course is a little bit more updated. I did a little bit of an update on some different aspects, but either one, the book on Amazon, How to Start Building Your Wealth, Investing in the Stock Market. You can just type in my name, Andrew Stotts, and the book's going to cost you, I don't know, $10 on Kindle, and I don't, and then the course is another option.
Amazing. And while you're clicking on the link, guys, let's put in the comments one thing that you are taking away, one thing that you learned, something new, something that stood out for you. Put it in the comments. Why? Because we're going to help each other. Maybe someone missed that point. And when you put it there, they read it and they're like, oh yeah, actually, that's a good point. So they will take that away. So you can put it in and we can all add each point to our notes that we've been taking.
Rachel.
I need to start investing now.
That's right. Start small. Start at what I always tell people is start at the absolute minimum.
Mm-hmm. Yeah.
Michael, who I think is Elizabeth, is there an audio version of the book? No, I never made an audio. I should, but I just never did. So it's only now if you take the course, you can listen and watch. You'll have lifetime access and all that, so you can go back and all that. But no audio version of the book yet.
Yeah. Okay. Thank you.
Yeah.
Takeaways: invest in funds, not individual stocks.
Yeah.
Yeah. As Andrew said, if you are investing in individual stocks, you do need three main things. You need knowledge, interest, and time. So if you do have those things, I guess you can buy index funds, automize the amount that goes each month, and open for children. Yeah, pound cost averaging works really well. You don't have to think about it. You don't have to worry about it each month. Look out for charges less than 1%. That's a good one, because even at 1% or 2%, you find out that the fees, they add up, they they rise pretty quickly. And when you find out the money that you have to pay in fees is this huge chunk, and you thought that you are going to retire with $1 million, and then you find out your fees actually cost this amount, you might be shocked. So yeah,
I'm loving these comments. You guys definitely got it. So I'm happy to see that. That was a great idea to ask people to comment like that.
Yeah, this is really good. So I'm going to save all these myself. Looking into Vanguard for my children, and look into bigger groups that could hold group stocks. Yeah, so it just helps you reducing risk, and that increased diversification just helps you reducing risk. A global diversified fund for me.
Yep.
Increase the numbers I currently have. Yes, I will yeah, I love this. I will make sure I'm constantly creating and investing funds to grow wealth. That is so key and well done, because we don't create any wealth in the stock market. We're just growing what we actually have. So to actually get something, you have to be creating it with, some kind of business, some kind of income generating vehicle, whether that's a job or it's a business.
And for me, I always wake up in the morning and I say, money flows to me.
Money flows to you. But it does. You have 80 million. So yeah.
I have that mantra and I love it and I recommend it to everybody.
Yeah. Okay, so Adeola, is Vanguard an app or something I can access on other platforms? You know what? If you stay behind after the call ends, I will talk to you about that. I will go on the website and I'll show you a little bit about that. I also learned the stock market is for great. Yes, it really is. Adding that affirmation. Okay, yeah, great.
Definitely. And make sure, Anu, when you do it, you open your hands up and you receive it. It's like money flows to me.
Money flows to me. Yeah.
And that's what I describe as wealthy, right? Because it doesn't matter. If money flows to me, I can give it away, I can help, I can invest, I can do a lot with that. I can take care of my mother or whatever, because I know tomorrow money flows to me.
Yeah.
It keeps flowing. And that to me is my definition of wealth.
Yeah. And that's a great definition. And I love that definition, because it's kind of, for me, my brain is interpreting it as I can always create the amount of money I need at any point in time. Why? Because I have something, I know I have maybe the skill or something that will help me
Yep.
consistently get that money flowing to me. What does VT mean? Okay,
Yeah.
Vanguard Total, I believe that's what it means, VT.
The VT is just the name of a fund, the Vanguard Total, and it's a ticker code or a code that we would call it, but it is a fund or an ETF. And in fact, hold on, I'll let me just see. Can we let me just see if I can get that. Okay, so I'll put it in the chat. Here's a link to it. It's not the Vanguard company link. It's actually an investing site link. So just click on it to learn about it, but don't do anything on that site because everything on the internet's trying to make money off of us. So just use it for information.
Information. Okay, I also got another question that came to me privately. So the big fund with like 1,000 stocks, will require you to invest how much? How much do you have to invest?
Usually the minimum with Vanguard is $3,000 as the initial amount to set up the account. And then you can, once you have your account open, you could contribute $100 and then accumulate that in your account and then buy the fund.
I think in the UK, the Vanguard also allows you now to open with 100 as well,
Yeah.
£100.
And what I always tell, like I said before, I always tell people, start with the minimum. That way you overcome the fear of starting, like the fear that you're gonna make a mistake. If you start with the minimum, you do the absolute minimum and do that for a couple months until you're comfortable, then you haven't taken a huge risk, and that's critical.
Yeah. And Bemi said she started investing with £50, which is really,
Okay, great,
so
good.
that is, so the fund is okay. So for the fund with 1,000, for the 1,000 fund is $3,000 or pounds. Okay, so with Vanguard in the UK, if you're based in the UK, you can open a Vanguard account with like an ISA account with like £100, or probably even less now. I'm sure they've reduced it recently. You can open it with that, a very little amount, and then you pick the fund that you want to invest in. And when you pick the fund that you're going to invest in, you will invest maybe £50 or £100 a month or 1,000, however much you want. And every time you invest in that fund, you're buying a little bit of that company, or a little bit of every company in that fund. So you're
Yeah.
owning a fraction of a share of every company in that fund. Hopefully once today postponed for too long. Yes, definitely. This send me a message as you have my private number. You should. I need to get that on my Vanguard. Yeah. Okay.
Yeah, I think you got some work to do to help everybody understand Vanguard too, or whatever
Yeah,
works.
it just happens to be what we both use, but
Yep,
it's
yep,
it's it's a low cost platform. Maybe
awesome.
to be paying us commission. But yes,
Mm.
thank you. Do
Well,
you have any?
my mom has just gone to bed and I'm gonna go say good night. So,
Thank you. So if there are no more questions, thank you so much, Andrew, for your
yep,
time here with us again. This is the second time Andrew is joining us in Welcome Little. So we are so excited to have you, and we hope you'll be back.
I look forward to it. And the next time we should have a party. Everybody turn on their videos and we'll toast the fact that everybody has started creating, growing, and protecting their wealth.
That sounds like an amazing idea. Let's do that. Let's do another session. And by
Yep.
that time, we would have all opened some form of investment account. And then we are now talking about a different level. We'll talk about investing, but at a
It's
different
it's
level.
it's like my graduation from my valuation masterclass boot camp. It's 6 weeks, and on the last night, it's graduation night. and we celebrate and share and we toast and we, yeah, party time.
I love parties.
Yes.
Yes,
All
yes.
right.
Okay, great. Okay,
Good.
so Ade, Ola, you can stay behind after the call, and BC, you can also stay behind. Thank you
Okay.
so much all for being here. Andrew, have a
Great questions. Yeah. Take care, Elizabeth. Always great to see you.
yes, and you too. Always great to have you.
Okay.
Thank
Take
you.
care. Yeah.
Bye.
Bye.